We often discuss political power, who holds the office, who signs the bills. But today, we are diving deep into a different kind of power: economic architecture.
Mm.
We are talking about the systematic structures, the rules, the hidden mechanisms built by those who control global capital, market speed, and, well, critical information.
That's exactly right. And the material you brought to the table, it paints this truly fascinating picture. It shows this concentration of wealth isn't accidental at all. It seems meticulously engineered, really, across centuries.
Right.
We're looking at tech empires, high-frequency finance, the playbooks of historical titans like Rockefeller and Carnegie. It's not just a list of successful people. It's more like a blueprint.
A blueprint for how they build.
Exactly, how they build, and maybe more importantly, how they protect their economic domains.
So our mission today, then, is to try and extract these universal strategies, the ones these economic architects use over and over to consolidate their influence.
Yeah, tracing that lineage of power, connecting, say, Wall Street's newest, fastest mechanisms directly back to the kind of infrastructure control used by the Carnegies and Rockefellers.
It seems so different on the surface, though.
Well, what's essential to understand here is that synthesis. The tools, they definitely evolve. You go from monopolistic control of railroads and oil pipelines to controlling the flow of data and milliseconds of information.
Yeah.
But the fundamental drive, the strategy for accumulating this, well, disproportionate wealth, that remains constant. Those monopolistic patterns from the early 20th century, you see them echoed so vividly in the centralization we see in AI today.
Wow. I had to read that opening synthesis a few times. It's incredible how quickly these seemingly distinct worlds, like old oil money and this new digital finance, they seem to use the same core strategies.
It's striking, isn't it?
Okay, let's unpack this then. How do the biggest players in the world build and protect their domains across these different eras?
Well, maybe we can start by analyzing the structure of this new bipolar world order, the one defined by AI and data concentration.
Okay.
Then we can pivot to the specifics of modern finance, try to demystify that hidden tax that comes from market structure and speed.
Right, the HFT stuff.
Exactly.
Yeah.
And finally, we can wrap up by examining the sort of historical and contemporary corporate playbooks, how they manage public perception, how they entrench rising inequality. Does that sound like a plan?
Sounds perfect.
Yeah.
Let's jump in. Okay, let's begin with that frontier of economic power: artificial intelligence. The sources you mentioned, especially referencing Kai-Fu Lee's analysis, they're extremely clear. The AI world order, it's already settled into this fixed bipolar structure.
Mm-hmm.
It's China and the United States, everyone else lagging far, far behind.
And it's more than just lagging. The sources suggest the gap is actually becoming insurmountable. We seem to be past the age of pure research and really entering what they call the age of implementation.
Implementation, okay.
Yeah. So while other nations, the UK, France, Canada, they have strong research labs, plenty of academic talent, absolutely.
Mm-hmm.
But they're missing two crucial ingredients.
Which China and the U.S. have in spades.
In abundance.
Yeah.
And these ingredients are really the foundation of this new architecture.
So what are they specifically?
First, the necessary venture capital ecosystem. You need VCs ready to deploy billions aggressively.
Okay.
And second, you need those truly massive user bases, the kind required to generate just mountains of proprietary data.
Because AI feeds on data.
Precisely. AI is fundamentally data-driven. It improves through what's called the virtuous cycle. More data feeds better algorithms.
Which makes better products.
Which creates better products and services, exactly. Better products attract more users who then generate even more data. It's this massive feedback loop. And as U.S. and Chinese companies just keep feeding this cycle, using their billions of citizens and, those deep VC pockets, they're widening that lead. It gets to a point where it becomes structurally, almost mathematically impossible for others to compete.
So it's not just a head start, it's like a self-accelerating engine.
That's a great way to put it, a self-accelerating engine.
And this domination, it's already incredibly concentrated, isn't it, into just a handful of huge corporations. The sources call them the 7 giants of the AI age.
That's right. You've got Google, Facebook, Amazon, and Microsoft in the U.S.
Okay.
And then Baidu, Alibaba, and Tencent BAT in China. And these companies, they aren't just sort of passively accumulating wealth. They're actively using these dizzying stockpiles of data and cash to make really bold plays, dominate this new economy, and, well, by extension, extract value globally.
What's fascinating, though, is the contrast the sources draw in the corporate culture that produced these giants, particularly the difference between, say, Silicon Valley's traditional way of thinking and the Chinese market. It feels a bit counterintuitive sometimes. Why does China's copycat culture, as it's sometimes called, lead to better implementation?
Yeah, the differences are profound, and they really speak volumes about how innovation gets driven in different environments. Silicon Valley, historically, it has tended to stigmatize copying. The emphasis is on originality, being first to market.
Right, the blue ocean idea?
Kind of. But the downside, as the sources point out, is that this focus can sometimes lead to a degree of, well, complacency. Entrepreneurs might nail the initial idea, but then fail to explore every possible iteration or adaptation once they've secured that initial market.
But in China, it was different.
Oh, completely different. In the rough and tumble of the Chinese market, it was, and in many ways still is, the Wild West. The sources really stress that the copycat era, while it was often messy, it actually incubated this whole generation of entrepreneurs who are incredibly nimble, savvy, and nose to the grindstone. Right. This highly competitive, just blistering pace of iteration. It was fundamentally driven by something else, the scarcity mentality.
Ah, right. The sources mentioned Deng Xiaoping's motto, let some people get rich first. How did that play out in terms of corporate behavior?
Well, it created this intense, widespread economic anxiety. A real fear that if citizens didn't move incredibly quickly to grab the next trend, the next opportunity, they'd just be left behind, trapped in poverty, while others achieved wealth almost overnight.
So desperation fueled innovation, or at least implementation.
It fueled rapid, ruthless iteration and deployment. Absolutely. If you could copy an idea and make it slightly better or just get it to market slightly faster, you did it immediately. No hesitation. That culture of speed and adaptability, that's what the sources identify as the kind of secret sauce. It allowed China to maximize returns in this age of AI implementation. It's like an internal pressure cooker, constantly forcing optimization.
And we see that same intense pressure, that drive for growth and dominance, playing out even within these giant corporations as they build their empires. The story of Facebook acquiring Instagram seems like a perfect example, how the machine imposes its will.
Oh, it's a classic case study. It really shows how the parent company has to impose its core DNA onto the acquisition to maximize its primary business. Right. And for Facebook, that business is data accumulation for advertising.
Right. We sometimes forget that.
We do. But Facebook's massive growth was utterly essential for its, frankly, revolutionary advertising model. This model relied completely on accumulating these vast stores of knowledge about users through every click, every like, every share, every action.
Which allows advertisers to get incredibly specific, granular.
Exactly. Super granular. It enabled this incredibly detailed personalization for advertiser targeting. So a business could, for instance, target, let's say, cat lovers in Toronto.
Okay.
Who specifically hold college degrees.
Wow.
And are also interested in organic gardening. That level of detail. Without that vast store of granular data, the whole ad model just falls apart.
So when Facebook bought Instagram, they weren't just buying a cool photo app. They were buying an untapped data source, a reservoir.
Precisely. An untapped data reservoir. And that's why the conflict described in the sources arose almost immediately. Facebook's growth team imposed demands on Instagram, pushing for things like a more functional website, but critically more frequent notifications.
The things the Instagram founders hated. They called it spammy, right?
They did.
Yeah.
They resisted. They felt it was detrimental to the platform's whole aesthetic, the user experience. But Facebook needed that daily user engagement. They needed those clicks and actions to feed the advertising machine.
So the parent company's needs won out.
Inevitably. The founder later reflected on the sheer hierarchy involved. When you become part of a company of that scale, there's really only room for one CEO. It underscores the finality of that kind of empire building. The ultimate success of the acquisition, from Facebook's perspective, depended entirely on subordinating Instagram's original ethos to Facebook's core data imperative.
That drive for speed, for extraction, it brings us perfectly to the second major pillar here, finance. And here, the architecture of power seems to revolve around, well, speed measured in microseconds, opacity in these complex market structures, and creating systems that just inherently extract value, what the sources call the hidden tax.
Yes, this concept of financial intermediation as a tax on capital is a really core insight from the source material, particularly Flash Boys.
Yeah.
In theory, you'd think technology would have dramatically reduced this cost, right? Or maybe even eliminated it. Buyers and sellers finding each other instantaneously.
Makes sense.
But the reality, as the sources detail regarding the rise of high-frequency trading, or HFT, is the exact opposite.
That part was genuinely shocking to read. Technology, instead of freeing up capital, actually increased the cost by billions of dollars.
That's what the analysis suggests.
Mm.
And the core mechanic behind this is pure speed, achieved through something called co-location.
Co-location. We need to unpack that carefully, I think, because it sounds technical, but the impact is huge.
It is. And it's not just about having fast internet. It's a physical architectural advantage built right into the market structure itself. HFT firms pay massive fees, huge amounts, to place their own proprietary servers inside the same physical building as the exchange's matching engine.
The actual computer that processes the trades.
The very computer that executes the trades. So they literally position themselves as close as physically possible to the source of the market data.
Feet away sometimes.
Sometimes just feet away. So think about it. When a large buyer or seller places an order, that information gets released digitally, often across multiple exchanges simultaneously.
Oh.
Because the co-located servers are physically closer to that data source, they receive the market data just microseconds, tiny fractions of a second, before that same signal can travel through miles of fiber optic cable to reach regular investors or even slower HFT firms further away.
And that tiny time difference is everything.
It's everything. That infinitesimal difference in distance allows HFTs to see the order coming, anticipate the price movement, and execute a trade ahead of it, or profit from a price change that hasn't even registered for everyone else yet. They are essentially front-running the market using pure physics. It's speed arbitrage.
It sounds like a guaranteed systemic profit opportunity based purely on that market timing advantage. And the source material captures the outcome, the wealth extraction, so vividly with that image of the financial intermediary changing over time.
Oh, that observation is brilliant, isn't it? It perfectly encapsulates the increased cost of this system. It used to be, the guy called Vinny, worked on the floor, maybe drove his Cadillac to a big house on Long Island. That was the old intermediary. Now, the new intermediary is the guy called Vladimir, who gets into his private jet and flies to his estate in Aspen for the weekend.
A stark difference.
A massive difference. The profits are vastly larger, they're secreted away more effectively, the complexity is far more opaque, and the toll levied on ordinary capital, on pensions, on mutual funds, on everyday investors is exponentially higher.
And this exploitation, it gets amplified by the use of dark pools, which, the name itself sounds pretty ominous, like a hidden market.
Well, that's essentially what it is. A dark pool is a private exchange, usually maintained by a big Wall Street bank. Trade orders are executed there anonymously, outside the public eye. And the sources point out that banks sometimes chose to keep large customer orders inside their own dark pools, rather than routing them out to the general public marketplace.
Why would they do that? What's the incentive?
A couple of reasons. Maybe to boost their internal trading statistics, make their pool look more active, or critically, they might charge a fee to an HFT firm that's allowed to operate within their private pool. They collect that fee instead of having to pay a fee to send the trade to another public exchange like the NYSE.
Okay, I see the bank's angle, but how does that create an arbitrage opportunity for the HFT firms inside that dark pool?
Right. So if a large institution decides to buy, say, a huge block of stock, and that order gets executed within the dark pool, that internal execution might cause a slight price movement just within that private pool.
Okay.
The HFT firm, operating inside that same ecosystem, sees that internal price flicker immediately. They can then anticipate, correctly, that this price movement will very soon be reflected in the public markets once the trade eventually gets reported or hits other exchanges.
So they trade on that prediction in the public markets.
In the milliseconds before the public markets fully react, they exploit this tiny predictive edge, resulting in what the sources graphically term a symphony of scalping. The initial decision by the big bank failing to send the trade outside its dark pool that was the original false note, as the source puts it, that created the profit opportunity for the HFTs.
Moving from these almost instantaneous trades of HFT, we see a similar kind of systemic complexity driving massive scale in another area. Private equity, specifically with leveraged buyouts, LBOs.
Yes, the whole LBO extravaganza, particularly in the 80s and 90s, was built entirely on financial innovation. Innovation designed primarily to spread risk while, crucially, centralizing fees for the banks arranging the deals.
Early PE funds like KKR showed it could be incredibly profitable, right? Turning small initial funds into huge gains.
Immense profitability. KKR's inaugural fund, just $25 million, reportedly turned into something like $500 million in profit over time.
Yeah.
But to finance the progressively larger and larger deals that came later, the multi-billion-dollar buyouts, the market needed something new. It required the development of the debt syndication machine.
Which was primarily pioneered by Jimmy Lee at Chase, according to the sources.
That's right. He was a key figure.
So can we break down what debt syndication actually meant in practice? Because the sources suggest it's the key innovation that allowed banks to, quote, rake off fees without filling their books with risky loans.
Certainly. So before widespread syndication, if a bank wanted to finance, say, a massive $5 billion LBO, they had to put most of that debt onto their own balance sheet. That exposed them to huge risk if the deal went bad.
Okay.
Jimmy Lee's innovation, and others built on it, was to create a mechanism for packaging up that debt the loans used to buy the company, and then immediately selling off pieces of that debt to a large group, a consortium of institutional investors. Think pension funds, insurance companies, mutual funds.
So the bank originates the loan but doesn't hold on to it for long.
Exactly. They arranged the deal, collected massive upfront fees for doing so, the arrangement fees, and then distributed the actual risk, the loans themselves, out to this wide network of other investors. The banks were reduced, essentially, to being arrangers, not long-term lenders.
So they're no longer the lender holding the bag if things go south. They're just the toll collectors on the way in.
Precisely. They raked in huge fees and walked away relatively clean, leaving the institutional investors often managing public or retirement money to hold the potentially risky loans long-term. This structure allowed deal sizes to explode. It attracted a flood of non-additional capital into the LBO market.
But the sources connect this directly to the later financial crisis, don't they?
They draw a very clear line. This same securitization apparatus, packaging debt and selling it off, built on incredibly high leverage and often very narrow margins for error, well, it also pumped up the subprime mortgage markets. And that led directly to the 2007 financial panic. Investors suddenly realized they were overloaded with complex debt they didn't fully understand, panicked, and simply recoiled. The system seized up.
And on the level of individual firms during that crisis, the sources provide that really specific anecdote about Goldman Sachs, how foresight, or maybe just tactical betting, saved them.
Yeah, that anecdote is critical for understanding how firms position themselves during the crisis. Goldman traders, the sources mention names like Michael Swenson and Josh Birnbaum. They made the critical opposite wager.
They bet against the housing market.
They fundamentally understood the inherent instability building up in the securitized housing market. So they bet against the ABX index.
Which was the key benchmark, the thermometer for that market.
It's a main indicator, yes. The ABX index was basically a basket of derivatives financial contracts whose value is derived from underlying assets tied specifically to those risky subprime mortgage securities.
So when the housing market inevitably collapsed,
the ABX index plummeted, and Goldman's bet against it paid off spectacularly. That specific, calculated move to short the market was instrumental, the sources argue, in saving the firm from the fate of its peers, like Lehman Brothers or Bear Stearns.
It's incredible. And while these financial architects operate in these, relatively visible markets like stocks and bonds, the sources also highlight another group, the commodity traders, operating with a scale that seems almost nation-state level, often below the public radar.
Their scale is just astronomical. It's hard to even comprehend. In 2019 alone, the turnover, just the value of goods traded by the four largest commodity traders, firms many people have never even heard of, like Glencore, Vitol, Trafigura,
Right.
totaled $725 billion.
Billion with a B.
Billion. That single-year turnover exceeds the total exports of an entire advanced industrial economy like Japan.
Wow.
And during the big China-led commodity boom in the 2000s, their combined profits were reportedly larger than giants like Apple and Coca-Cola combined. They are the hidden conduits, the plumbing, of global physical trade and infrastructure.
And the sources detail how these massive firms, like Glencore, weren't just passive traders. They were actively involved in helping build the financial architecture of entire countries during periods of massive transition. The example given is Russia in the 1990s.
Absolutely. It's a key point. When the old Soviet economy was rapidly privatizing in the 90s, these Western commodity traders sponsored a number of oligarchs, funded them, often acting as their very first financiers.
How did that work?
They were essential in teaching these emerging Russian economic players how to export their newly acquired raw materials, oil, metals, etc., onto the global market. They provided the seed capital, the connections needed to buy up large swaths of the privatizing state assets.
But it wasn't just about logistics, was it?
No, crucially, the sources emphasized that these traders linked the new Russian oligarchs into the existing Western financial system. They taught them, quote, the tricks of tax havens and offshore shells.
The same tricks the traders use themselves.
The very same tricks these traders have been perfecting for decades to shield their own massive global profits from taxes and scrutiny. So they weren't just enabling trade, they were exporting the architecture of financial secrecy.
Which brings us neatly, if disturbingly, to the most opaque area of financial power discussed. The secrets, the insider culture, the systematic manipulation, the ethical breakdown that seems to fuel so much wealth at the top.
Yeah, the sources provide some pretty stark evidence of a culture built, in some cases, on outright illegal activity at the highest levels. SAC Capital, the giant hedge fund run by Steve Cohen, is a prime example.
They eventually pled guilty, right?
They signed a guilty plea, admitting the firm had fostered essentially a decades-long culture of insider trading. The penalty was staggering, $1.8 billion. But the anecdote provided really illustrates the casual nature of the crime sometimes.
You mean the Dell email?
Exactly. Highly confidential, pre-release earnings information about Dell Computer was passed via email directly to portfolio managers at SEC. And the instruction attached was simple, chillingly direct. Please keep to yourself is obviously not well known.
Just use this illegal information, but don't tell anyone.
Pretty much. It wasn't some incredibly convoluted scheme in that instance. It was a straightforward instruction to use material, non-public information for profit. It reflected, the prosecution argued, a deep-seated cultural acceptance of cheating to gain an edge.
And then there's the systemic manipulation, like the LIBOR scandal, which seemed to require an environment that actively obscured what was going on, making it hard for regulators or the public to spot.
The complexity itself became a shield. Manipulating LIBOR, which remember that the benchmark interest rate reflecting how much banks charge to lend to each other, was incredibly difficult for outsiders to detect.
Why was it so hard to see?
Well, first, the daily submitted rates didn't usually involve massive, obvious jumps. Second, the manipulation wasn't consistently directional. Sometimes traders wanted LIBOR slightly higher, sometimes slightly lower, depending on their trading book. And third, critically, the actual definition of LIBOR was historically fuzzy. It was often based on banks' estimates or submissions, not necessarily actual transactions.
Oh, there was wiggle room.
Lots of wiggle room. And banks often lacked explicit, clear internal rules about precisely how their employees should arrive at the submitted rate. Traders like Tom Hayes, who became the poster child for the scandal, ruthlessly exploited these ambiguities.
And while Hayes faced serious consequences,
He did prison time. But the sources make a crucial point about the broader cultural failure. Many other colleagues at multiple banks who were involved to varying degrees in the manipulation faced far lighter consequences, or none at all. Many were still employed in the finance industry years later, or had simply moved on to lucrative positions at hedge funds. The system itself in many ways protected the players even when the game was proven to be rigged. ##33, the blueprint of ideology and inequality.
okay, so this complex financial architecture we've just dissected, the speed, the secrecy, the manipulation, it feeds directly into this rising tide of modern global inequality, doesn't it? A pattern that economic historians like Thomas Piketty have meticulously documented.
It absolutely does. And the reversal of post-war norms is really stunning when you look at the data. After World War II, many Western nations experienced what economists call the Great Compression. Inequality, both wealth and income, actually decreased significantly for several decades.
But that trend didn't last.
Not at all. It's been sharply reversed over the past, say, 5 decades, driven in large part by the very financial and corporate systems we've just been discussing.
The data cited for the very, very top slice of earners is almost unbelievable. For the top 1,000th, that's the best remunerated 0.1% in English-speaking countries, their share of national income saw this unprecedented rise. It vaulted from about 2% in the mid-century to nearly 10% in recent decades, a 5-fold increase in their slice of the pie.
It's a dramatic shift. And while the rise was maybe less extreme in continental Europe and Japan, even there, the share of national income going to that tiny elite group nearly doubled. This isn't just random fluctuation. Piketty's work provides a fundamental mathematical explanation for why this happens, especially when high returns on capital meet low overall economic growth rates. It's his second fundamental law of capitalism.
Right, that formula, beta st dollar, and the really crucial part, three Dougal dollars. It looks a bit intimidating on the page, but it seems to be the engine driving modern wealth accumulation. Can you break down that dynamic in sort of human terms?
Sure, let's start with the core principle. This simply means that the average rate of return on capital, think profits, dividends, interest, rent, capital gains from investments, is consistently greater than the overall rate of economic growth, which largely reflects wage growth for most people.
Okay.
Historically, this has generally been true. And projections cited in the sources suggest that for the 21st century, the average return on capital is expected to be around 4 to 5% per year, while long-term economic growth is projected to be much lower, maybe only around 1.5% per year.
So, put simply, if your income comes primarily from working, your wealth tends to grow with the economy, around 1.5%. But if your income comes primarily from existing wealth, from capital you own or inherited,
Your wealth grows significantly faster at that 4 to 5% rate, inherently.
so wealth accumulated through inheritance and investment essentially compounds, potentially 3 times faster than wealth earned through labor and wages.
Exactly. That's the core engine. Low overall growth, combined with relatively high rates of saving among the wealthy since the 1970s, that accounts for this dramatic comeback of capital's dominance over income from labor. That gap, the persistent difference between $20, is what drives wealth concentration across generations, making it harder for those without initial capital to catch up.
And the financial sector itself, based on our earlier discussion, acts as this massive accelerator for the divergence, pulling talent towards extraction rather than, say, creation.
That is arguably the crucial sociological consequence identified in the sources. The rise of the financial sector itself accounts for about 26%, over a quarter of the entire increase in the U.S. income gap over the last 4 decades.
Wow, a quarter of the increase just from finance.
That's from the finance sector's growth and wage structure. And this is hugely exacerbated by what economists call the finance wage premium. It's estimated to be somewhere between 30 to 40%.
Okay, that number is critical. Let's make sure we understand it. You're saying if we take two individuals, maybe with identical skills, identical education, identical work ethic,
Yep.
the one who applies those skills on Wall Street in finance will automatically command a salary that's 30 to 40% higher than the one who applies those exact same skills in, say, product engineering, scientific research, teaching, or public service.
That's what the research suggests. It's a systemic super return paid simply for working in that specific industry. The highest wages, the largest bonuses, are often paid for complex optimization, proprietary trading, financial engineering activities, which, as we discussed with HFT, sometimes boil down to just optimizing that tax on capital.
Which creates a powerful incentive structure.
An incredibly powerful incentive structure that systematically siphons elite talent, top graduates from top universities, away from fields that might create more tangible, broadly shared societal value, and pulls them towards maximizing financial extraction. And that financial privilege, that extreme wealth at the very top, it also seems to correlate with a very specific, almost traditional family structure, reinforcing that generational divide, maybe.
It's an interesting observation from the sources, yes. The data suggests that for taxpayers in that top 0.1% bracket, a significant majority had a non-working spouse.
Which is different from the middle class.
It reflects a much more, you could say, patriarchal family structure, persisting at the very peak of the plutocracy, contrasting sharply with the dual income norm prevalent throughout much of the rest of the income distribution today.
Why is that significant?
Well, if one partner, typically the husband, in these cases, according to the data, is earning, say, $10 million a year purely from capital gains or these highly inflated financial sector salaries, the family unit can easily opt out of the economic necessity of dual incomes. It perhaps reinforces a social model where inherited wealth accumulation rather than earned income from multiple workers becomes the primary driver of family economics, echoing in some ways the pre-industrial rentier class.
Okay, let's shift focus now to the concrete strategies corporations use. Not just to make money, but to protect those wealth streams and, crucially, to shape the public's reality around their operations. We see this playbook deployed whether the product is oil, tech, or, as in one chilling example, pharmaceuticals. The first tactic seems to be aggressively engineering the market itself, often through deception or just incredibly intense systematic marketing.
The Purdue Pharma playbook for OxyContin is a really clear and frankly disturbing example of this kind of systematic demand engineering. even after pleading guilty to federal charges of misbranding the drug, basically misleading doctors and patients about its risks.
Right, they'd already been caught.
Exactly. But their internal training documents revealed they didn't suddenly focus on ethical compliance. Instead, the training focused sales representatives on developing a specific plan for systematically moving physicians to move to the next level of prescribing behavior.
Systematically moving them, it sounds methodical.
It was entirely methodical. They weren't just passively taking orders or presenting information. They were meticulously cultivating higher and higher prescription rates.
Oh.
Sales reps were armed with specific scripts, key messages that work, designed explicitly to ensure continual sales growth by pushing doctors to prescribe more opioids more frequently and in higher dosages over time. It was a calculated plan to maximize sales volume and corporate profit, prioritizing market expansion seemingly above all else, including public safety.
And we see a somewhat similar pattern, maybe, of leveraging a really captivating, almost humanitarian vision, even when the underlying technology was, well, fraudulent in the spectacular rise and fall of Theranos.
Oh, Theranos is a classic Silicon Valley story, albeit a cautionary one. It attracted massive initial buzz, hailed as the hottest startup in the valley.
Why? Why?
Because Elizabeth Holmes sold this incredibly compelling narrative, the vision to revolutionize healthcare, to potentially eliminate the estimated 100,000 American deaths each year from adverse drug reactions, all through simple, personalized blood monitoring from a tiny drop of blood. The vision was so powerful, so seductive.
That it attracted top talent, huge investment.
Exactly. Top talent, powerful board members, massive investment. It effectively masked the deep operational flaws and ultimately the fraud for years.
But the basic operational checks and balances, they were actively bypassed, weren't they?
Repeatedly.
Yeah.
The sources note they specifically rejected the fairly standard idea of embedding a Walgreens consultant within their operations, which would have been an obvious safety and quality control measure. And then, of course, whistleblowers later revealed the company was actively cheating on its proficiency, testing the tests regulators used to ensure lab accuracy. As the source starkly states, this wasn't just cutting corners, it was the functional equivalent of breaking the law.
So the vision, the ideology of changing the...
It became the shield behind which the corporate deception operated, allowing it to persist far longer than it should have.
Okay, so tactic one is engineering the market and the narrative around the product. The second massive tactic highlighted is the direct control of public narrative and political discourse. This feels like where media empires meet monopolists. A tactic used just as effectively by someone like Rockefeller a century ago as it might be by tech giants today.
Absolutely. Look at William Randolph Hearst, the newspaper magnate. He had an incredibly clear understanding of this. He saw that controlling the daily press and later newsreels was, in his view, tantamount to control of public and political discourse.
He didn't just want to report the news.
Far from it. He didn't stop at just reporting. He actively pushed for specific political mechanisms, things like the initiative, referendum, and recall.
Why those specific reforms? They sound kind of democratic.
On the surface, maybe. But Hearst pushed them because they were political tools designed specifically to weaken the existing power structures of the time, namely the established political parties and their bosses.
Bypass the party.
Exactly. By weakening the parties, he, through the immense leverage and reach of his newspapers, could position himself as the central political arbiter. He could speak directly to the people, framing the issues, endorsing candidates, bypassing the traditional political machine entirely. His media voice gained exponential power over legislation and public opinion. It was a brilliant, if self-serving, architectural move to consolidate his own influence.
And the old guard monopolists, the ones being attacked by muckraking journalists like Ida Tarbell, they learned this lesson quickly too, didn't they? That sheer economic power wasn't enough. They had to manage their public image. John D. Rockefeller seems like the prime example.
He's the absolute archetype of this image rehabilitation strategy. Had he died around, say, 1902, the sources suggest he would have been remembered almost exclusively as this ruthless, brilliant, but narrow man of swashbuckling brilliance. A predator.
But the muckrakers changed that perception.
Figures like Ida Tarbell, whose father was ruined by Standard Oil, began portraying him as the devil incarnate, the face of corporate evil. And Rockefeller, or rather his advisors, realized they had a massive PR problem. So he executed this masterful pivot, 2 parts. Massive, unprecedented philanthropy.
Right, founding universities, medical research.
Exactly. And, crucially, systematic corporate public relations. He basically invented the field.
He hired the first corporate publicist.
According to the sources, yes. He hired a former journalist, Joseph Clark, specifically to, quote, warm up the trust's image. And this effort wasn't passive. It involved systematically placing positive, often lighthearted articles in the press, things with titles like The Human Side of John D. Rockefeller.
Humanizing the monopolists.
Precisely. And the PR efforts were so incredibly effective over time that later, during World War I, when the government actually had to urge the different Standard Oil companies, which had been broken up by antitrust action, to cooperate and pool their efforts for the war, Rockefeller apparently gloated privately that, quote, the government itself has adopted the views that the Standard Oil leaders have held all these years about cooperation being efficient. He didn't just win the economic battle, he ultimately won the narrative battle too, convincing even the government that his monopolistic way was, in fact, the right way.
Beyond PR, protecting these immense fortunes often involves really intricate legal maneuvering, doesn't it? Specifically around taxes and inheritance. A game played skillfully by titans like Howard Hughes.
Oh, Howard Hughes is a fascinating case. He faced this soaring federal income tax bill in the mid-20th century when top rates were very high, and he devised this highly complex but incredibly effective strategy to deal with it. He would go into the charity business.
Philanthropy as tax avoidance.
Essentially, yes. Establishing the Howard Hughes Medical Institute wasn't purely altruism. It was structured as, in his own reported words, an intricate and superbly effective accounting device. A legal mechanism designed primarily to shield his massive wealth from federal income and estate taxes. It's the ultimate convergence, perhaps, of philanthropy, tax avoidance, and, well, self-serving legacy building.
And we also see examples of how these titans managed internal conflict, how they protected their personal reputations while still ensuring their sometimes ruthless business strategies were carried out. Andrew Carnegie during the Homestead strikes seems like a textbook case of strategic delegation and maintaining distance.
It's a classic example. Carnegie clearly laid out the overall strategy for dealing with the union at his massive steel plant in Homestead. He wanted the union broken to cut costs. That was the goal.
But when things got violent,
when the conflict escalated dramatically, the lockout, the hiring of Pinkerton guards, the pitched battle, the deaths was Carnegie conveniently distant. He was literally out of the country vacationing in Scotland.
Plausible deniability.
Completely. He could protect his carefully cultivated image as the enlightened philanthropist by stating publicly that the tragic events were, quote, as much news to me as to yourself. He feigned ignorance and shock.
So he shielded his reputation while still achieving his primary business objective, which was breaking the union's power.
Precisely. The sources reveal he privately admitted to colleagues that his manager, Henry Clay Frick, who was on the ground, had perhaps erred grievously in his handling of the situation, specifically in using the Pinkertons so aggressively.
But he didn't say that publicly.
Absolutely not. He was very careful not to voice those sentiments publicly, primarily for fear that the indispensable Frick would resign if undermined. Carnegie prioritized maintaining his corporate structure, achieving his anti-union goal, and preserving his long-term public image over taking any personal responsibility for the short-term violence and loss of life. It was a calculated, arguably brilliant exercise in managerial distance and reputation management.
Finally, underlying all these specific strategies, from HFT speed to Carnegie's delegation to Hughes's tax schemes, there seems to be this bedrock requirement, this relentless, almost maniacal determination that just has to be built into the entrepreneur's DNA to succeed at this level.
That foundational philosophy, that sheer relentless persistence, it's captured perfectly in the sources by Ray Kroc, the man who built the McDonald's empire from a small burger stand. His favorite homily apparently encapsulates this internal engine needed for empire building.
What was it?
Persistence and determination alone are omnipotent. He argued forcefully that neither talent, nor genius, nor education could ultimately replace that sheer, dogged, relentless will to just keep pushing, keep iterating, keep overcoming obstacles, and keep accumulating. That drive seems to be the common denominator.
Wow. Okay, so we've taken this deep dive into the blueprints of modern power, and what really stands out to me listening back is the consistency, the sheer consistency across time and industries. Whether we're discussing the microsecond speed advantage of HFT firms today, or the global data monopolies of the AI giants, or Rockefeller's control of oil transport a century ago, The tools, they're constantly being refined. They get faster, more complex, more global.
Absolutely. The tools change.
But the underlying engine, that relentless drive to accumulate wealth, to influence policy, to control public perception, that seems to be a completely consistent theme across centuries.
It does seem to be the common thread. We dissected the data, particularly from Piketty, illustrating this staggering, almost unprecedented rise in top-tier wealth concentration in recent decades.
Right.
And we connected it explicitly back to that simple but powerful mathematics of Tordino, and also to the specific financial and corporate structures often built on layers of complexity and secrecy that enable and accelerate this accumulation.
We saw that common thread, the ability to structure the system itself to favor your position, whether that's through physical co-location in an exchange,
Or using offshore tax havens.
or controlling the daily press, or now maybe the algorithms that curate our news feeds.
It's about controlling the critical infrastructure, whether that's data pipelines or railroad lines. Ensuring you have systemic advantages, like speed or leverage. Eliminating or absorbing the competition, like Facebook did with Instagram or Carnegie wanted to do with the union via Frick.
And always, always managing the public narrative. Whether it's Rockefeller's philanthropy or Theranos' world-changing vision, it's the architect's playbook.
Which leads us back, I think, to that central societal cost we touched on earlier. We established from the sources that the rise of finance contributes significantly to modern inequality, driven partly by that compelling finance wage premium.
Right, that 30 to 40% bonus you get just for applying your skills on Wall Street instead of somewhere else.
Exactly. So if that premium exists and it powerfully draws talent,
What does it all mean for the rest of society when this economic architecture we've described actively dictates where our brightest minds end up focusing their energy?
well, that really raises an important and maybe unsettling final question for you, the listener, to consider. If the most highly educated, the most quantitatively skilled individuals in our society are disproportionately incentivized by these huge financial rewards to gravitate towards financial engineering, towards proprietary trading, towards optimizing that tax on capital, instead of, say, fundamental scientific research or building better infrastructure or developing new clean energy technologies or improving public health systems or teaching. What are the long-term non-monetary societal costs of that massive allocation of elite talent? What essential systems, what potential breakthroughs, what life-changing innovations are maybe left undeveloped or underfunded or severely neglected when so many of the brightest minds are focused primarily, almost entirely, on extracting existing value within the financial system rather than creating new, tangible value for society as a whole?
That's a heavy question to end on, but a crucial one. If you're a learner out there interested in these deep connections between wealth, power, corporate history, and the hidden mechanics shaping our economy, we certainly hope this deep dive into the source material gave you plenty of moments to chew on.